Hi, welcome to the session of Financial Management's Capital Budgeting. In this session, we would be learning about capital budgeting concepts such as net present value, internal rate of return, profitability index, and payback period. The aim of this video is to teach you capital budgeting concepts in less than half an hour, right from the start till the end, without skipping any key concepts, and also to show you a couple of mathematical examples. I believe by the end of this video, whatever the doubts you have would all be cleared. So if you are a project manager or an MBA student or an entrepreneur, stay tuned till the end of this video, and I promise to do justice for the time being spent on this learning. So what exactly is capital budgeting? In simple terms, it is finding out whether or not to invest money in a project. So let's say you're given two projects to choose from and you can invest only in one project. Then how do you make informed decisions? This is what exactly we're going to learn in this video. Capital budgeting techniques uses the following criteria to make informed decisions. 1. Net present value, which is also called as NPV. And 2, it is internal rate of return, abbreviated as IRR. And then we have profitability index, sometimes it is written as PI, and we have payback period. So what is net present value? At a high level, it tells us about what is the value of the return on investments. And what is IRR? At a high level, it tells us the percentage of return on the investment. So NPV tells us the value of return, the IRR tells us the percentage of return. And profitability index is nothing but determining for every dollar that we spend on the project, how much are we getting back. And finally, we have payback period. It tells us the break-even point to recover our investments. It tells us by what time or what period we can recover the investments made into the project. Okay. Capital budgeting techniques fall under the umbrella of financial management. So it is important to know where in financial management these capital budgeting techniques fall into. Let me take you through an overview of financial management just so that you can get some idea as to which branch of financial management deals with capital budgeting. Now, if you are trying to make a note of this, don't worry, I'll be sharing you the presentation link in the description and you can download that and you can keep it with you for your reference. It is a 40 slides presentation. You see, I'm trying to take care of your learning here. So please stay with me, and I believe you will take a lot of learning from this video if you're trying to learn about capital budgeting techniques. All right, let's get back to the topic. So the financial management is primarily divided into two functions. 1, corporate finance. 2, accounting and control. And these are further divided into sub-functions. Each function is a big subject in itself and would take hours, if not days, to learn about them. And our focus would be on capital budgeting. So I have highlighted them in yellow here. It falls under the corporate finance function, under investment decisions, and under projects. So in general, any organization, before undertaking any project, they would conduct two types of studies. One is technical feasibility study and another one is financial viability. If a project is not technically feasible, then there is no point in going ahead with the project. So the project ends there before even getting started. And let's say the project is technically feasible, then the organization would conduct the financial viability to know whether it is worth to invest the money in the project or in some other asset or some other project. So if you plan to become a financial management guru, learn all these functions. Okay, so let's move on to the next slide. Before we get started with capital budgeting techniques, there are few concepts that you need to be aware of, and that really helps you to grasp this subject with a lot of ease. And there is a term called opportunity cost. And for those who do not know what is opportunity cost is something that you would give up in order to get something else. For example, if I'm not making this video, then I would be spending this time probably reading a book or something else. And the opportunity cost for me for making this video is the time lost reading that book or doing something else. But then why would people let go the opportunity cost? Because people think rationally and they would weigh the pros and cons of each activity before they do and choose the best alternative available at the point in time. Okay, so on the screen you have two options. You can either invest the money in your bank or in a project, and if you invest the money in the bank you get 8% returns, and if you invest your money into the project you get 10% returns. So what is the opportunity cost of the money if invested in a bank? The answer is 10%, because you are losing 10% that you could have gotten from the project if invested there. Now, if I use the same example, what is the opportunity of the cost of money if invested in the project? And I believe you got it right. The answer is 8%, because you're losing 8% that you could have gotten from the bank if you have invested the money in the bank instead of a project. So we have two mutually exclusive events here. If you invest in bank, you lose the returns from the project. If you invest in project, you lose the returns from the bank. So in each case, you have the opportunity cost. Just keep this opportunity cost in mind. It will be coming in forthcoming slides. And this concept is really important to understand capital budgeting techniques. And there is another important concept that you need to learn for capital budgeting. That is nothing but discounted cash flow and non-discounted cash flow. Discounted cash flow is a financial word for opportunity cost. So in a way, discounted cash flow is nothing but the opportunity cost. Sometimes the word discounted cash flow is written as cost of capital or opportunity cost of capital. These all terms mean the same. Again, for a quick reference, let's look at this question. Let's say if an organization earns 10% per annum on its capital by putting the money in the bank instead of investing in a project. Now, what is the opportunity cost of the capital? You're right, it is 10%, because that is what you are losing for choosing to invest in the project. And now, what is non-discounted cash flow? It is simple. It means that we are not considering any opportunity cost, and we don't have to think about any discounted cash flow. Now here comes a consideration to keep in mind. In general practice, discounted cash flow is taken into consideration while calculating the net present value, internal rate of return, and profitability index. And for payback period, we do not consider the discounted cash flow. So if you're still watching, then we are making a good progress with the subject. We need to learn one more concept called time value of money. I'll explain it in the simple terms possible, and post that we will get into the real meat of the subject, and then you will realize how easy they are going to be by knowing these simple concepts. So stay tuned with me, please. And I believe it is important concept to learn, not just because of the financial management, but in general too. Let's take a look at it. So to give you an example, the money that is sitting in your wallet right now is worth more today than the same money sitting in your wallet tomorrow. Can you tell why? Because the value of money depreciates over time. If you're not putting that money into use, it is just depreciating its value. So you can ask, why is it depreciating in value? It is the same $100 bill that you're carrying in your pockets. The reason is time. Yes, time. As many of us think, it is not just about the money, but it is always about the time and money together. And this brings us to the fundamental concepts of time value of money. There are two fundamental concepts that we need to learn about time value of money, which is future value of money and present value of money. And let's go ahead and look into that. Let's understand the relationship between the future value of money and the present value of money. Luckily, we have a formula for it, and the formula is FV is equal to PV multiplied by 1 plus K whole power N. Here, FV means future value, PV means present value, K means discounted rate or the opportunity cost, and N means time. So let me tell you good news. If you observe carefully, this formula is nothing but a compound interest rate formula that we may have learned in our school days. Okay, So let me give you another good news. It is just one formula that you need to remember to do all the calculations of capital budgeting techniques and nothing more, right? And if we need to calculate the present value, you just send 1 plus k to the power of n to the other side of the equation, and that makes the present value formula as future value divided by 1 plus k to the power of n. And let's do a few calculations using the formula, and then let us calculate the future value. On the screen, you see an example. If $100 is invested in a bank today, it would earn 8% per annum interest. Then what is the future value of that $100 after first year, 5th year, and 15th year? In this scenario, the 8% is our discount rate, which is nothing but the opportunity cost. And $100 is the present value. And we need to find out the future value of that $100 for the first year, 5th year, and 15th year. So the value of PV is $100. And the value of n is 1 for first year, and the value of n is 5 for 5th year, and 15 for 15th year. And the opportunity cost is 8%. That means k is 8%, which means 8 divided by 100, and that gives us the value of k as 0.08. And let's plug these numbers into the calculations. To simplify, I first calculated the value of 1 plus k, which is 1 plus 0.08, and that gives me 1.08. And for the first year, it is 100 multiplied by 1.08 to the power of 1, and that gives us $108. And if you do the calculations for the 5th year, it is 100 multiplied by 1.08 to the power of 5. And if you do the math, it comes up as $146.93. Okay. Similarly, if you do the math for 15th years, it is 100 multiplied by 1.08 to the power of 15, which gives us $317. Now let's go ahead and look into how to calculate the present value. Let us take the same example. The example on the screen states that if you're going to get $100 after first year, what is the present value of the $100 today? And if you're going to get $100 after 5th year, then what is the present value of that $100 today? Similarly, if you're going to get $100 after 15th year, what is the present value of that $100? Now, if you observe carefully in this scenario, it is talking about receiving $100 on a future date. That means the $100 here is the future value. We have the time, that is n is equal to 1 for the first year, n is equal to 5 if we have to calculate for the 5th year, n is equal to 15 for 15th year. So the discounted rate is given as 8%, and we need to plug in these numbers into the formula and do the calculations. Now I have done the calculations on the screen here. These are the numbers that I got. You can pause the video and do it yourself and cross-verify if you're getting the same numbers. And so to summarize, k means 8%, which is 8 divided by 100. That gives us 0.08. If you add 1, it gives 1.08. And for the first year, it is 100 divided by 1.08 to the power of 1. And that gives us the present value of $100 as $93. And if you do the calculations for the 5th year, it is 100 divided by 1.08 to the power of 5, and which gives us the number as $68. And similarly, if you do the calculation for 15th year, you're getting the value as $32. And with these, we've completed the concepts part. Let's quickly recap what we've learned so far. We've understood what is opportunity cost, which is nothing but the discounted cash flow. We've learned about non-discounted cash flow as well, which is nothing but we're not taking into consideration any opportunity cost. We have understood what is time value of money and learned about the future value of money and present value of money, and learned the formula that we need to use to calculate the future value and present value of money. So we're about to get into the meat of the subject, and it is going to be easy as we've already looked into the basic concepts that we need to be aware of. So stay tuned until we finish these calculations. All right, let's now start with net present value. The key word here is net. Net present value means from the sum of all present values you need to remove the cash outflows. If I have to give you an example, in your salary slip, your gross salary is the sum of all your income, and if you remove your taxes, your savings, etc. from that, you would be left with your net salary. Likewise, for net present value, you need to remove all the cash outflows from the sum of all present values. Let's do an example calculations and it'll be easy to know. Before we do the sum, just remember the criteria. If the net present value is greater than 0, then it is better to accept the project and we can work on the project. And if the net present value is negative, which is less than 0, then we should reject the project. We should not accept a project which has a net present value in negative. And if the net present value is exactly equal to 0, then you can accept the project given the project is giving you some other experience and then some other tangible benefits. So higher the net present value, it is better for our return on investments and better for us. So let's do the math now for net present value. A sum of $400,000 is invested today in an IT project. It may give a series of cash inflows as described on the screen, which is $70,000 for year 1, $120,000 for year 2, $140,000 for year 3, and $140,000 for year 4, and $40,000 for year 5. And if the opportunity cost is 8%, should we accept the project or not? This is what we're going to find out. So in this question, $400,000 is the investment that we are making. That means we're spending the money out, which means this is a cash outflow. And the cash inflows are 70,000, 1,20,000, 1,40,000, 1,40,000, 40,000 for year 1, 2, 3, 4, 5 respectively. So first we need to calculate the present value of all these years. And then we need to sum these present values. And whatever the value we get, we need to remove the $400,000, which is a cash outflow, for us to get the net present value. Okay, we have the discount rate as 8%. Since we have to calculate the present values, let's use the present value formula. Okay, let's plug these numbers into the present value formula. For year 1, the amount is 70,000. K means discount rate, which is 8%. And if you do the calculations, we get the present value for the first year as 64,814.8. And for year 2, we have the amount as $1,20,000. And if you do the math, we get the present value for year 2 as 102,880.7. Likewise, if we do for year 3, year 4, year 5, these are the values that we get. And as a part of the rule, we need to sum up all the present values, and if we do that, we get the value as 408,959.5. And for the net present value, as I said before, we need to remove the cash outflows. So if you remove $400,000 from 408,959.5, it leaves us with $8,959. This is a positive number. This is a positive net present value, which means we can accept the project. Now let's go ahead and do one more calculations on net present value with the same example, but this time instead of using the discount rate as 8%, let us make it 15% and see what's the outcome of the project. Okay, so you can pause the screen and do the calculations, but I have done it for you. If you plug in the numbers to the formula, the net present value comes up as negative $56,408, which means the project is not financially viable because we have a net present value as negative here. So the key point to note here is when we used the discount rate as 8%, we got the positive net present value. And when we used the discount rate as 15%, we got the negative net present value. So what does it mean? It means that net present value is very much dependent on the discounted cash flow. Okay. And if you get a question like, would the net present value change by the change in discount rate? The answer is yes. Okay. As the discount rate goes up, the net present value would come down. Both are inversely proportional. Now let's look at the internal rate of return, or simply called IRR. IRR is nothing but the percentage of return that you're going to get on your investment. So how do you calculate the IRR? If you remember from our net present value example, as the discount rate increases, the net present value decreases, right? So we need to figure out at what discount rate does the value of net present value becomes 0, and the rate at which the net present value becomes 0 is the actual rate of return from the project. The criteria for the internal rate of return is if internal rate of return is greater than discount rate, then accept the project. And if the internal rate of return is less than the discount rate, then reject the project. And if the internal rate of return is equal to the discount rate, then you may accept the project considering other project benefits. Also, let's look at the other relationship between internal rate of return, discount rate, and net present value quickly. So whenever internal rate of return is greater than discount rate, your net present value is going to be always positive. And if the IRR is less than discount rate, then the net present value is going to be negative. And if the internal rate of return is equal to discount rate, then the net present value is going to be 0. Let's now look at the example for calculating internal rate of return. The cost of the project is $1,000 and has got a time horizon of 5 years, and the cash inflows are for year 1 it is $200, for year 2 $300, for year 3 it is $300 again, for year 4 it is $400, and for year 5 it is $500. The opportunity cost is given as 12%, and we need to confirm if we can accept the project. Here the future values of all the 5 years are given. We have the cash outflow as $1,000. We have the discount rate as 12%. Since the question is to calculate the internal rate of return, we first need to calculate the net present value. If it is greater than 0, then we need to increase the discount rate, let's say like 13% or 14% or 15%, and then we need to recalculate the net present value. And the moment your net present value becomes 0 at whatever the discount rate it is, that discount rate is considered as internal rate of return. When we do the calculations, you will get to know more about it, okay? I have automated this particular step in an Excel to save time on calculations. So here you see K value as 12. 12% means 12 divided by 100, which is 0.12. And 1 plus K means 1 plus 0.12, which is 1.12. Down below, you see the year 1, 2, 3, 4, 5, and the future values 200, 300, 300, 400, 500. And next to it, the value of 1 plus K to the power of N. And again, next to it, the formula of present value. The moment I change the value of K here in this row, it gets changed here, and the present value gets automatically computed. Down below here, I'm summing them up to get the sum of all present values. And here I'm removing the cash outflow from cash inflows to get net present value. Since our aim is to calculate the internal rate of return, we need to change the value of the discount rate to see at what discount rate the net present value becomes 0. And that rate is considered as internal rate of return. Let's see here. At 12%, we get the net present value as 169, which is higher than 0. So we need to increase the discount rate and we need to check what the net present value is going to be. So if I change the net present value from 12% to 13%, we get the net present value as $136, which is still high. Let's do one thing. Let's change it to 18% and see what the value is going to be. Okay, so if we change it to 18%, the value here becomes negative. But we need the net present value as 0, neither negative, neither positive. Okay, so let's try 17. No, at 17.5, we close. Let's try 17.7. Okay, we get the net present value as 0.25. So let's try 17.8. Okay, it becomes negative 2.38. So at a discount rate of 17.7, the net present value becomes 0.25, which is close to 0. So therefore, we need to consider this 17.7% as our internal rate of return. And now, since this internal rate of return is 17.7, which is greater than the discount rate of 12%, we can very well accept this project. So this is how you calculate the internal rate of return. Okay, now let's look at the profitability index. So what is profitability index? It is knowing for every dollar we spend, how much are we getting back. It is easy to calculate. We just need to divide the cash inflows by cash outflows, and it gives us the profitability index number. Let's do the calculation here. Okay, in this example, we need to calculate the present value for the year 1, 2, 3, 4, and 5 and sum them up, and that gives us the value of all cash inflows. And here we have cash outflow. We just need to divide the cash inflows by cash outflows, and it gives us the profitability index. I have done the calculation here and got the cash inflow as 26,814.29, and we know the cash outflow is $25,000. So if we divide 26,814 by 25,000, we get 1.07. And since the profitability index is greater than 1, we can accept the project. And I did the same calculation here in Excel, so you can download the presentation and you can refer to the sheet. Okay, and now let's look at the last technique of the capital budgeting, which is payback period. As the name suggests, it is the break-even point at which we can recover our initial investment. Here are some of the criteria for payback period. A good project will not only have a good net present value or the internal rate of return, but it also will have an early payback period. Let's say you have two projects, and if all the values remain the same, such as the net present value, the internal rate of return, or profitability index, then your criteria is the early payback period. Having an early payback period means you can recover your money early and you can invest that money into other projects. Okay, as I have mentioned earlier, for payback period we will not consider the discount rate. Okay, so let's look at the example. It's the same example we have looked into for profitability index. Let's now calculate the payback period for the same example. So what we need to do is we need to figure out when we can recover our investment. The initial investment is $25,000. In year 1 we recovered $5,000, and in year 2 we recovered $9,000. So in total we recovered $14,000 till the end of year 2, which is nothing but the sum of 5,000 plus 9,000 in cumulative numbers. And using the same cumulative addition, by the end of year 3 we can recover $24,000 in total, and that leaves us with $1,000 more to recover. So by the end of year 4 we can recover up to $34,000. Since we only are concerned with recovering $25,000, what we can do is we can break the $10,000 in the year 4 by month wise. So it will give us $833 per month. So going by this logic, we can recover our investment in about 3 years and 2 months time. So with this, we finished the calculations on capital budgeting techniques. So on the screen, there are a few tips to make a note of from your examination point of view. I think this is important, so I have collated them here. This is in the presentation. I just wanted to put them all in one place for your convenience. It is in the PPT anyway. If you like to download the PPT, you can visit the link in the description section and then download it. So let's do a quick recap as to what we have learned in this video today. We have started with the definition of what is capital budgeting techniques. We looked into the financial management overview. We learned about opportunity cost, which is nothing but the discounted cash flow. We learned about time value of money, with which we can calculate the future value and the present value using the one and only formula that we have. And then we did a couple of examples on net present value, internal rate of return, profitability index, and payback period. And if you have any questions, just leave it in the comment section. I would try my best to answer each and every comment here. And some final comments before we finish the video. If you liked the video, I would really appreciate if you could subscribe, because I do have very few subscribers and it would be a privilege to have you as one of my subscribers. And I also request you to share this video with your friends to help them clear the concepts if they have any doubts in capital budgeting. It'll just not only help them, it'll help this video to come up the ranking a bit. Okay, so that's what it is. I'll see you again in another video. Until then, keep in touch.